Coming up on the Wheelhouse Retirement Show, you've been preparing for retirement for years. But do you know how an inverted yield curve could potentially disrupt your long-term strategies? Today, you'll learn the key components of the yield curve, along with how significant swings in your portfolio early on or leading up to retirement may change your entire plan. Rishi and the team will walk you through it. Plus, later on in today's planning tip of the week, a new tool in investing called buffered ETFs. Rishi explains the pros and cons behind this strategy. The Wheelhouse Retirement Show starts right now.
Retirement is more than a destination. It's a journey that starts with a dream. A vision for the way you want to live, recharge, and give back. To get there, you need a plan to make your retirement dreams come true. Now in its second season, the Wheelhouse Retirement Show provides you with the essential strategies needed to plan your ideal retirement. From income planning and wealth management to strategies for taxes, long-term care, and leaving a legacy, Rishi Ghosh, Anthony Stryker, and the team at Wheelhouse Advisory Group provide modern solutions and comprehensive plans for your journey to and through retirement. This is the Wheelhouse Retirement Show.
Welcome to the Wheelhouse Retirement Show. I'm Amy Sharp. Joining me once again today, Rishi Ghosh and Anthony Stryker with Wheelhouse Advisory Group. It is always great to be back with you guys. How are you?
Very good. Happy to be here.
All right.
Excited to be back.
Before we get into our topic today, the business of the day, it's really important that we ask this question. How's dad life?
Amy, it is absolutely incredible. I know you're always keeping up with little Miss Naya Ghosh, and as cliche as it sounds, she truly does have me wrapped around her finger. I mean, I always assumed I was going to be the parent to let her cry it out, as a lot of parents know, but that baby girl makes a peep at night, and I am up and at 'em to my wife's dismay, as you can imagine. So we took our first family vacation, the three of us, to beautiful Jacksonville, Florida. Spent 2 or 3 days just relaxing by the pool, and got to the beach one day, and I actually got to also celebrate my first Father's Day as a father. So here she is, my big old brown-eyed girl, and I love her to death. So.
We can't tell. We can't tell how you all of a sudden have changed just a little bit while you're up here. It's not business all the time anymore, is it?
Not to mention she's obsessed with her Uncle Anthony too. So
he's a little softer as well.
I would say probably so. Well, thank you for the update. I'm sure we'll probably talk about her again, and hopefully someday she'll join us here on the set.
Future CEO of Wheelhouse.
Okay, and if we have to turn and talk to Uncle Anthony now, we'll talk business, I guess.
All right.
We are talking today about yield curves, and I've heard you both reference this before. We haven't really taken a deep dive on this topic before, so I want you to tell us what it is. What do retirees need to know about this in terms of how it relates to their retirements?
So while yield curves aren't as exciting as baby Naya, it is important for our clients and our viewers to know about, in our opinion. And so what a yield curve is a line graph, and we've got a normal yield curve here on the screen where it shows debt instruments. A yield curve is the line graph showing with debt instruments, fixed income, such as CDs and bonds, how much yield or how much interest we're going to get for certain maturities. And because of that, this normal yield curve shows longer term maturities getting higher yield. Essentially, the longer you keep your money in a fixed income investment, such as a bond or a CD, you're probably going to get more bang for that buck by keeping that money in that investment for a longer time. So this is a normal yield curve where we have shorter maturities with smaller yields and smaller interest, and longer maturities have higher yields there.
Okay, what about the term inverted yield curve? I've heard you talk about this. What does that mean?
So really it's the exact opposite, and it is an unusual scenario when the yield curve does invert. But this often happens when investors are feeling like interest rates might fall in the near future or not so distant future. And so this is when, as you can see, kind of counterintuitive to what I had just said, of where a shorter term maturity debt instrument or fixed income product is actually going to get a higher yield. So you could have a 1-year CD earning, say, 5%, while a 3-year CD might be at 3%. So it's an unusual situation when it inverts on itself, this inverted yield curve.
Okay, there's a lot to pack in here. The question a lot of our viewers want to know is, why is it important for them to know about the yield curve when it relates to their retirement?
The main reason why we like to talk about this is, and as Uncle Anthony mentioned over here, it is an anomaly when the yield curve inverts itself, and it has happened many times throughout history. But the reason why a lot of people over the last few quarters have been talking about it, especially with the yield curve inverting, is the potential sign that it could be the impending sign that a recession might be coming up. I know a lot of our viewers want to forget about one of the most famous inverted yield curves, which was in 2007, and obviously that led to the 2008 market crash, that and a lot of other factors as well. But the reason why a lot of people understand or need to understand this is when we have an inverted yield curve, and as Anthony mentioned, short-term debt is paying a little bit more than long-term debt, which is exactly, as he mentioned, counterintuitive to normal investing. Oftentimes people look at it as the economy is slowing down. Businesses are less likely to hire, businesses are less likely to lend, and in that situation you're going to have a little bit more of an implosion, a little bit slower of an economy, and the potential sign that a recession might be coming up.
So it's an indicator of this, of a potential recession. How so?
There's a lot of different reasons on why it is an indicator, and we'll go over the history of it being an indicator as well. But these top three reasons are, first of all, it can lead to a decline in lending. So when we're expecting interest rates to fall, consumers are less likely to lend money to businesses and other consumers there too. So that's a slowdown, a less of a stimulus of the economy there. It can also lead to a decline in stock prices. If we see that short-term interest rates on CDs and bonds might be, 4 or 5%, we might want to jump into those. Some of our viewers, some of our population might jump into those investments as opposed to holding their money in the risk side of the stock market there. So that's where we can have some slowdown for those U.S. companies and those U.S. stocks too, and worldwide as well. And then also, it just overall can lead to a decline in consumer spending. If consumers and regular people out there are looking and seeing, I'm not going to get as much bang for my buck for a longer term investment, they might just be more inclined to keep money in a bank account, a money market account, and they're not spending as much because they're worried about how much that money might not earn over the time of their investment there.
Anthony, Rishi, important insights as always. Thank you so much. Up next, we continue to discuss yield curves and how they may have an effect on your retirement. Rishi and Anthony explain what you might be overlooking in your plans for the future. Plus, Rishi explains buffered ETFs. That's coming up later in today's Tip of the Week when the Wheelhouse Retirement Show continues. Stay tuned.
Have you thought about your plan for long-term care? Do you need a policy to pay for it, or can you self-insure? If you have questions about long-term care planning and all the options available to you, you're not alone. I'm Lauren Ferraro, and our team at Wheelhouse Advisory Group can help you create a plan to meet your personal needs and protect your hard-earned assets. If you are confused or concerned about planning for long-term care, call us today to learn how to steer your future in the right direction.
Welcome back to the Wheelhouse Retirement Show. I'm here today with Rishi and Anthony discussing yield curves and how they can impact you when planning for retirement. And guys, we've really taken a broad view of the yield curve and what it can mean, but of course our viewers ultimately want to know what it does mean to their retirement and their planning process.
Amy, why I think it's so important to be talking about this topic right now is over the last few quarters, we've seen the yield curve actually invert itself. And one of the yield curves we brought here was from June of 2023, showing exactly what Anthony mentioned from the first segment. Shorter term instruments actually paying a higher yield than longer term instruments. And the reason why I think this is so important of a topic for pre-retirees and retirees to truly understand is because this can cause issues or potential ups and downs in their portfolio. Oftentimes during recessions, stocks could retract, could go down during that time frame. So if people have a lot of equity risk, the value of their portfolio could also decline. And most of our clients are reliant on their portfolio, whether it's for day-to-day expenses, one-off expenses, to help fight inflation, or potentially long-term care costs many, many years into the future, or hopefully not recent, but soon, making sure that you have a portfolio that whether stock prices go up and down, whether bond prices fluctuate up and down, whether economies are growing or retracting, making sure you understand that that is a potential, especially when the yield curve inverts, is very important.
Okay, so while we know the inverted yield curve isn't necessarily a sign of an impending recession, we shouldn't stay short-sighted, I'm assuming, as retirees when we start to really plan.
That's absolutely right. And pre-retirees who are within that 3 to 5 year window of retiring, they've been accumulating money for 20, 30, 40 years, some of them, and our clients and our viewers are getting ready to spend that money. Retiring, unfortunately, it's not quite the finish line for us over here. It's getting them to and throughout their retirement there. So I want to make sure that, even if there's lulls when different things react in the market, that people are aware of those risks there. So for instance, we talked about that leading indicator of when the yield curve inverts, the stock market having a recession or the overall economy having a recession. That lull on average takes about 12 months to happen. So everywhere from 6 months in 2019 to the 2020 COVID recession that we have, to all the way up to 22 months that we're showing on the screen from our last worst stock market crash in 2008, 2009 was 22 months between when the yield curve inverted and when we actually started a recession here in the U.S. economy. So we want to make sure that we don't forget the risks that are out there, even if there has been some time passed between one thing happening that might lead to a recession.
Yeah, and you both talk a lot about that holistic plan. At what point does someone really consider switching to a holistic retirement plan versus maybe just looking at their investments and other strategies?
Here we always tell people, when you get to the point where you say, Rishi, Anthony, if you make me another $1 million, that would be great, but at this phase of my life, I don't want to lose $1 million. That is when we believe people should start transitioning from more of what we call an accumulation-based portfolio, which most of our viewers have been in for 30, 35 years while they were growing their money, into more of a retirement planning-based portfolio. And as Anthony mentioned, we really try to get people not to be too short-sighted, because oftentimes if a yield curve inverts itself, oftentimes for a few months leading up after that or post that inverted yield curve, stock markets sometimes go up, economies tend to go rip-roaring, not all the time, but sometimes as well. So people often forget that, there could be a recession coming or there could be a decline coming at some point in the future. So for us here, for people looking for a timetable, we believe that once somebody enters this 5-year time window of leading up to retirement and transitioning to retirement, that is generally the time to start thinking about moving from this accumulation-based portfolio into more of a planning portfolio. The main reason being is if we look at every major market correction in this country, assuming you do not touch your money, it generally takes somewhere between 2.5 to 3 years to get back to break even. For our clientele that are planning for this next phase of life, we always tell people we don't want to have $2 million in our 401k today, wake up tomorrow and be down to 1.3, and then fight for the next 1 year, 2 years, 3 years leading up to retirement, just trying to get back to break even. We have to utilize these last 5 years of working, and especially the first couple years into retirement, of trying to figure out how do we move ahead without moving backwards. And if all we're trying to do is fight to get back what we had already, oftentimes we are not pushing ahead at that point.
Yeah, we've been talking about this even during the break, that this is a lot to digest, and it's a perfect time for you both to really just let our viewers know, come see you, come sit down and talk about this topic.
It's a great time to start thinking about it, if making sure that we have the secure and worry-free retirement is a big goal for the family.
All right, Anthony, Rishi, great insights as always. Coming up after our break, Rishi will walk us through the pros and the cons of a new investment strategy called buffered ETFs. That's next in our planning tip of the week. Then later, we will welcome Lauren Ferraro back to the studio, and she and Rishi will explain why avoiding a big hit to your portfolio at the beginning of retirement is so critical.
Did you know taxes could be your biggest expense in retirement? No one can avoid taxes completely, but with the right strategies in place, you could potentially reduce your tax bill in retirement. Having a plan to protect your retirement savings from higher taxes could mean more money in your pocket and less to the IRS. At Wheelhouse Advisory Group, helping people like you minimize your taxes in retirement is something we are truly passionate about. Call us today to learn ways to possibly lower your taxes in the future.
Hi, I'm Rishi Ghosh with the Planning Tip of the Week. On this Advisor Tip of the Week, we are discussing a new investment strategy known as buffered ETFs. Here at Wheelhouse Advisor Group, we joke that investments change like electronics, and every quarter there seems to be a new hot product for investors to understand. And understanding these investments and weighing the pros and cons of these investments before making any rash portfolio changes is always important in order to have a successful retirement strategy. While over the last 10 to 15 years, ETFs have become a more popular option for cost-effective and diversified investing, they are not all created equal. Buffered ETFs are a type of exchange-traded fund that offer investors a way to limit the downside risk while still participating in upside potential of the stock market. They do this by using options to create a buffer between the ETF's price and the performance of its underlying index. For example, if a buffered ETF has a 5% buffer, would lose no more than 5% if the underlying index fell by 10%. In return for this downside protection, the ETF's upside is capped at a certain level, typically around 7 to 10%. Here is how buffered ETFs work in more detail. The ETF issuer buys a put option on the underlying index. This option gives the ETF the right, but not the obligation, to sell the index at a certain price known as a strike price on a certain date, known as the expiration date. The ETF then sells a call option on the underlying index. This option gives someone else the right, but not the obligation, to buy the index at a certain price on a certain date. The difference between the strike prices of the put and the call option is the buffer. For example, if the ETF has a 5% buffer, the strike price of the put option will be 5% lower than the strike price of the call option. In the event of a market downturn, the ETF will be protected by the put option. If the underlying index falls below the strike price of the put option, the ETF will exercise the option and sell the index at the strike price. This will limit the ETF's losses and the amount of the buffer. In the event of a market rally, the ETF will not participate in the full upside potential of the underlying index. This is because the ETF will be capped by the strike price of the call option. For example, if the ETF has a 5% buffer and the underlying index rises by 10%, the ETF will only rise by 5%. Buffered ETFs can be a good option for investors who want to reduce their risk without sacrificing too much potential return. They can also be a good choice for investors who are nearing retirement and looking to protect their capital. However, it's important to understand the pros and cons of buffered ETFs. Before investing, let's start with some of the pros to consider. First, downside protection. Buffered ETFs aim to provide some level of downside protection during market dips. They use derivatives or other hedging instruments to limit losses within a specific range. This can be appealing to investors who are risk-averse or concerned about potential market declines. Buffered ETFs also offer a predetermined level of protection, which can help investors better understand their potential losses during adverse market conditions and set appropriate expectations. This predetermined level is usually expressed as a percentage buffer. Like traditional ETFs, buffered ETFs typically hold a basket of underlying securities, providing investors with diversification benefits and reducing individual stock risk. Additionally, buffered ETFs can be more cost-effective than actively managed funds because they usually follow rules-based strategies rather than requiring constant adjustments by portfolio managers. As with any investment, there are potential negatives or cons to be considered as well before making any changes to a portfolio or plan. Some buffered strategies can be complex due to the use of derivatives and various hedging mechanisms. It is important to do thorough research or to talk to a professional before considering a buffered ETF as part of your investment strategy. Although buffered ETFs come with a bit of protection, the protection comes at a cost. In this case, looks like limited upside participation in strong bull markets. The buffer cap or maximum return level could prevent investors from fully benefiting from significant market gains. Another potential downside is buffered ETFs that might experience tracking errors due to the implementation of their buffered strategies. These discrepancies can lead to differences between the fund's performance and underlying index or benchmark. While buffered ETFs can be cost-effective relative to actively managed funds, they may still have higher expense ratios than traditional passive ETFs, which could eat into your overall returns. It is important to remember that specific pros and cons of buffered ETFs may vary depending on the strategy employed in your plan, the underlying assets, and the market conditions. As with any investments, it's essential to conduct thorough research, understand the strategy, and consider your risk tolerance and investment objectives before investing in buffered ETFs or any other financial product. All of our clients and longtime viewers should know by now, our philosophy has never been to add investments into a portfolio and then hope they work into the overall plan, but rather build a total retirement holistic plan and then decide piece by piece which investments and strategies will give you the best opportunity for success. Once a plan is made, we can still tweak the individual products if a new worthwhile option presents itself. Always seek the advice of a financial or tax professional to see how buffered ETFs could be used in your retirement plan and how you may be able to utilize them for a more strategic and tax-advantaged retirement. That's today's planning tip of the week. Stay with us. The Wheelhouse Retirement Show continues next.
For some of us, Social Security could be $1 million decision. Hi, I'm Rachel Belmar with Wheelhouse Advisory Group. After doing the math, the average monthly Social Security payment adds up to nearly $600,000 over 30 years. If you're married and you double that number, now you're talking a little over $1 million. With a decision this big, we encourage you to talk to someone who can help. Call us today for your Social Security analysis.
Welcome back to the Wheelhouse Retirement Show. We're back with Rishi Ghosh and joined now by Lauren Ferraro. It's great to be back with both of you.
Thank you, Amy. It's great to be back today.
Excited to be back.
All right, let's jump right into it. We have been talking about just kind of really being on top of it when it comes to your retirement. And you think about that 5-year window that a lot of times people will talk about, or really in the early years. Why is it so important to avoid taking that big hit to your portfolio?
Amy, as you know, our specialty is helping people transition from the growth phase of their life into more of the distribution phase of life. And as we've talked about, while we're not saying an inverted yield curve is a guaranteed sign of a recession, as Anthony mentioned earlier in the show, oftentimes between the yield curve inverting and a recession starting, sometimes it can be 12 months as long as 22 months. And we want to make sure that retirees and our viewers are not too short-sighted when we're in times of yield inversion. So here at our practice, we always like to back up our plans with math. So every single client at our practice gets something called a retirement analyzer built from them, where we show them the projection and the differences between what we call a smooth retirement and a potential bumpy retirement as well. So just quickly, a typical Wheelhouse situation as we start building people's income plans, both current and future. So we have Frank and Nancy. They're 63, 62 years old, and they're going to be retiring at 64 and 63, about a year into the future. So Frank's a Boeing engineer with about $140,000 worth of income, and Nancy's right at that $66,000, so their current income. Now the future income they have, like some people, 2 Social Securities. So they're deferring their Social Securities till 67, taking it at full retirement age. And Frank's got that great Boeing pension as well of $3,500 a month, and he's chosen the 100% joint survivor. So we build out their current income plan, and then we build it out into their asset allocation mix. So here we can see they've done a great job of building some emergency funds, about $100,000. And when we look at all of their other accounts between Frank's Fidelity 401k with 1.2, a nice Roth IRA, which is our favorite account with $175,000, they've got about $1.7 or so million saved up. And this family has told us, after some budget analysis, that they need about $8,000 a month indexed for inflation into the future in order to pay their bills and maintain their lifestyle. So the first step for us is to build out, are they on the right track for retirement through a smooth retirement plan?
And so as we see here, our typical client comes to us with this current asset allocation mix of about 90% at risk and then about 5% low risk, 5% emergency funds. So basically what this is showing is our clients are coming in the accumulation phase. They've done a really good job of saving over the years, but now that they're nearing retirement, we want to move them into that distribution phase. So our financial planning department, part of the retirement analyzer they put together, is preparing this projection to show what income the client will have in retirement. So if we look here again, we have Frank and Nancy. We can see what their pension income is, what their Social Security income is, which makes up their net monthly income. And then we have their net monthly expenses, their net monthly cash flows, the amount that would come out of their portfolio. And what we want to focus on here is that spendable assets column. We're always going to use a 4% rate of return in our projection, so we're going to err on the more conservative side. We don't want to have to rely on a high rate rate of return for our clients to have a successful retirement. So we're going to err on the more conservative side. You can see on that spendable assets column, every 5 years, that continues to grow. It doesn't drop until Frank and Nancy reach the age of 90, and that's due to inflation. So really what's important is to avoid those big hits in the market. So in this example here, Frank and Nancy both lost about $500,000 due to the market correction. So the market was down about 25%. Stocks were down 35%, maybe bonds were down 10%, but overall they were down about 25%. So their spendable assets start down to about $1.2 million. As you can see, year after year, their spendable assets continue to deplete, and by age 97, they're projected to have no money left in spendable assets. Again, that's by having a market correction of about 25% in this example. So one thing our clients may say to us is, well, we hope the market's going to come back. Well, as we've said before in prior shows, hope is not a strategy that we can use, because when you have a big market hit like this and you're in retirement, you don't have as many years to make up for that.
That's right. We don't want to hope, we want to plan. And as we kind of finish out this segment, I think the question on a lot of people's minds is, what do I need to be planning for if I'm concerned about an inverted yield curve or just taking a hit in general?
Sure. So we have a couple strategies that we work with our clients on when we do the total financial planning. The first one is rebalancing the portfolio. So, if interest rates are up, bond prices are down, maybe that means we shift from bonds over to stocks. Another important aspect that we help with our clients is to make sure they create a strategic income plan. So that means if the markets are down, we don't want to have to generate losses by selling those market investments. So we want to make sure we create an income plan that makes sense, having about 10 years set aside, protected, then about 20% for any one-off expenses that might come up in retirement. And then also making sure that our clients are set up with a well-diversified portfolio. So that may mean stocks, bonds, real estate, investments, insurance, but we want to focus on the whole investment plan, not just the products.
And then on top of that, I think staying informed is a big key. And as we know, the financial world and the financial economy is all intertwined. What's happening in America affects Europe. What happens in Europe affects Asia, and so on and so forth. And news from across the world all has an effect back here in the United States. So staying informed, and whether you're doing it yourself or trusting a fiduciary financial advisor to help guide you, it is very important for us. We believe that if you're going to entrust a fiduciary retirement planner, you need to make sure they are a total retirement planner. Somebody who's not going to just help you with only investments and focus on rates of return, but not rates of return, tax strategies, and estate strategies, all built together to help guide you efficiently into the future.
Rishi, Lauren, thank you so much for joining me today. And if you're ready to develop a total retirement plan like we've been discussing, don't delay. Reach out by the phone or on the web to get started planning for your ideal retirement future. For Rishi Ghosh, Anthony Stryker, Lauren Ferraro, and the team at Wheelhouse Advisory Group, I'm Amy Sharp. Have a great week, everyone. We'll see you next time.